I want you to hold two numbers in your head at the same time. Over the last 100 years, stocks have beaten real estate by 5 times. And yet, homeowners end up with 38 times more net worth than renters. Read that again. 5 times worse asset, 38 times richer owners. That math should not work. It has no right to work, and yet it works. Every single year, in every single data set, without exception. And the reason it works is the dumbest, simplest thing you have ever heard in your life. It is not the asset. It is not the market. It is not the timing. It is not the zip code. It is one single factor, and both your realtor and your stockbroker have a direct financial interest in never telling you what it is. Because the second you understand it, you stop needing either of them. My name is Smith. Today we're breaking down exactly which one will actually make you richer. Why almost everyone gets this completely wrong. And the one factor that decides the entire thing. Which, by the way, has absolutely nothing to do with which asset you pick. Drop a like and stay with me, because this one is going to change how you think about money for the rest of your life. Let me show you the number that started this whole conversation. Over the last 100 years, the S&P 500 has returned about 10.7% per year on average with dividends reinvested, adjusted for inflation. That is roughly 7.5% in real terms. U.S. home prices, measured by the Shiller index, returned about 4.2% nominal and somewhere between 0.3% and 1% real over that same century. Yes, real annual return on housing. Less than 1%. Now what does that actually mean in dollars? If you took $100,000 and put it in the S&P 500 for 30 years at the historical average, you would end up with approximately $1.9 million. If you took that same $100,000 and parked it in raw home appreciation, ignoring everything else, you would end up with about $340,000. That is a 5.6 times difference. Stocks do not win this race. They absolutely lap it. So we should all be selling our houses and dumping everything into index funds. Right? Wrong. And this is exactly where it gets interesting, because real estate has a cheat code that stocks do not have. It is called leverage. When you buy $100,000 of Apple stock, you put up $100,000 of your own money. When you buy a $500,000 house, you put up $100,000 and the bank hands you the other $400,000. Suddenly you control 5 times more asset than your cash should allow, and every single dollar that house appreciates flows back to your tiny down payment. Here's the math that breaks people's brains. $420,000 house, $84,000 down. If the house goes up just 3% in a year, that is $12,600 of appreciation on your $84,000. That is a 15% return on your actual cash from a 3% move in the asset price. Add in the principal you paid down on the mortgage, roughly $3,800 in year 1, and you are looking at close to 19.5% return on your cash from a house that barely beat inflation. If the house goes up 5%, your cash-on-cash return is closer to 28%. That is better than the stock market in almost every single year on record. This is why your dad keeps telling you that houses are the only real investment, because mathematically, when leverage is working in your favor, almost nothing on earth touches it. But, and there is always a but in finance, because finance is mostly buts. Leverage is a switch, and that switch flips both ways. Let me show you what that actually looked like the last time it happened. The S&P 500 dropped 56.8% from peak to trough in the 2008 crash. Brutal, no argument. But it recovered fully by March 2013, including dividends. 5.5 years from disaster back to new highs. If you held on, you came out fine. U.S. housing prices dropped 27.4% on the Shiller National Index, half as bad on the surface. But the full nominal recovery did not happen until late 2016, and in real terms, adjusted for inflation. Housing did not make a new high until May of 2022. 16 years to recover from a crash less than half as severe as the stock market. In Las Vegas, prices fell 61%, Phoenix 53%, Miami 49%. People who bought in those markets in 2006 did not break even until their kids were in middle school. Now, apply leverage to that. $84,000 down on a $420,000 house. House drops 20%. House is now worth $336,000. You owe $336,000. Equity. Zero. You cannot sell because there is no money left to pay the realtor. The market made you rich on the way up. It made you a prisoner on the way down. Stocks do not do this to you. If you own $100,000 in index funds and the market drops 30%, you have $70,000. You are sad, but you are free. You can sell tomorrow. You can move tomorrow. The asset does not own you. So why does anyone use a leverage at all? Because most of the time prices go up. And when they do, you are the one holding the bag of gold. Okay, I know that was a lot of numbers. Stick with me. Because we have not even talked about the costs yet. And the costs are where this whole conversation gets genuinely uncomfortable. When somebody tells you their house went from $200,000 to $550,000, nope, they think they made $350,000. They did not. Property taxes in the U.S. average about 1.1% per year. That is $4,600 right off the top every single year on a $420,000 house. In New Jersey, 2.23%. Texas, 1.6%. Property taxes do not stop when you pay off the mortgage. You will pay them every year until you die or sell. They are the rent you pay to the government for the privilege of owning a house you already own. Homeowners insurance averages $2,800 a year nationally. In Florida, the average is now $10,200 per year to insure one house. Insurance has gone up 51% since 2021. Maintenance follows the 1% rule. About 1% of your home's value per year. Another $4,200 annually. Owning a house is basically a subscription to a building. Except the subscription randomly tries to destroy you with plumbing. Some years nothing happens. Other years your AC dies, your roof leaks, and you write a $19,000 check while somehow pretending to be calm in front of the contractor. Then there's HOA fees. PMY if you put less than 20% down. Closing costs of 2 to 5%. A 5.5% realtor commission when you sell. Add it all up. And the typical homeowner who holds for 7 years pays roughly 10 to 15% of their home's value in pure friction costs before the house has appreciated a single dollar. Real estate does not have an expense ratio. It has a tax bracket. Stocks, by comparison, charge you basically nothing. The Vanguard S&P 500 ETF charges 0.03% per year. That is $3 on every $10,000. No property tax, no insurance, no leaking dishwasher, no phone call at 11 p.m. from a tenant whose toilet just exploded. Here's where most people get this completely backwards. Robert Shiller, the economist who literally invented the housing index we have been using this entire video, ran the numbers on what Americans think their homes returned versus what they actually returned. The average homeowner estimates their real return at about 7% per year. The actual real return going back to 1890 is closer to 0.4%. That is not a small mistake. That is overestimating reality by 17 times. And it is not because homeowners are stupid. It is because the human brain remembers the sticker price going up and forgets the $230,000 they quietly shoveled into the foundation over 30 years. You remember closing day. You forget every property tax bill, every insurance renewal, every Saturday at Home Depot. The sticker is dramatic. The drip is invisible. So when your uncle at Thanksgiving tells you he tripled his money on his house in 25 years, what he actually did was barely keep up with inflation while paying for a place to live. He is not lying. He is just running the wrong math. And almost everyone runs the wrong math, which is exactly why real estate always wins survives as a belief, even though the data has been saying the opposite for 100 years. But before you cancel your house tour and put everything into VOO, here is where stocks have a serious problem. You are the problem with stocks. The asset is completely fine. You are the one who keeps panic selling at the exact bottom. A research firm called Dalbar tracks this every single year. They found that the average stock investor underperforms the S&P 500 by 3 to 5 percentage points per year. Not because the market is rigged, because the average investor checks their account every morning panics during corrections, sells when it hurts, and buys back in once everything feels safe again, which is of course when prices are higher. Real estate accidentally protects you from this. You cannot panic sell your house. The transaction takes 60 days. You pay a realtor 5.5%. You have to pack up your kids. You have to find somewhere else to live. The friction that makes a real estate annoying is the exact same friction that saves you from your own brain. This is why the average homeowner ends up wealthier than the average renter, even though the math says they absolutely should not. The Federal Reserve's survey of consumer finances found that the median homeowner has a net worth of $396,000. The median renter has a net worth of $10,400. That is a 38 times difference. It is not because the houses appreciated 38 times more. They did not. It is because the mortgage forced people to save every single month whether they felt like it or not. And the illiquidity stopped them from screwing it up when the market got scary. Your house is essentially a savings account with extra steps. You put money in every month. You cannot withdraw on a whim. And one day, 30 years later, you wake up with an asset worth several $100,000 that you cannot remember actively building. Quick word on taxes. Because this is where real estate flexes muscle that stocks simply cannot match. Sell your primary residence and you can exclude up to $250,000 in capital gains if you are single. $500,000 if you are married. Completely tax-free. Stocks do not get that. The IRS takes 15 to 20% of your stock gains. Rental real estate is even more powerful. You can depreciate the building over 27.5 years, which gives you a tax deduction for an expense that never actually happened. The 1031 exchange lets you sell a rental and roll the entire gain into another property without paying capital gains, potentially forever. And when you die, your heirs get the property at a stepped-up basis, meaning all those deferred gains just disappear. The tax is never paid by anyone. It is called buy, borrow, die, and it is the most efficient wealth preservation strategy ever legally invented. The catch? Most of this only matters if you're already wealthy. For normal people, stocks have a better tax shelter, and it is called the 401k. If your employer matches your contributions, that is an instant 50 to 100% return on every dollar before the market does anything. Nothing in real estate matches an employer match. Nothing. Fidelity reported there are now 544,000 401k millionaires in America. The average one is 59 years old, has been in the same plan for 26 years, contributes more than 17% of their income. They did not time the market. They did not pick stocks. They just kept feeding the same boring index fund every 2 weeks for a quarter of a century. Here is something nobody talks about, because it would put a lot of YouTube real estate gurus completely out of business. Buying a rental property in 2026 does not work in most of America. The classic rule was the 1% rule. Monthly rent should be at least 1% of the purchase price. A $200,000 house should rent for $2,000 a month. That rule is dead in basically every major U.S. market. The median home price is now $412,000. The median rent is around $2,050. That is a 0.49% ratio, less than half of what makes a rental cash flow positive. Run the actual math on a $400,000 rental at $2,500 a month, 20% down. At today's 7.1% investor mortgage rate, after property taxes, insurance, maintenance, vacancy, and property management, you are losing roughly $12,400 a year, almost $1,035 a month, out of your pocket. On top of the $80,000 down payment you already put in. Your cash-on-cash return is negative 15.5% in year one. Mortgage rates are higher than rental yields in almost every single U.S. metro. The math does not work, period. Anyone telling you to buy rental properties right now is either lying, not running real numbers, or selling you a course. So who actually wins this thing? Ramsey Solutions studied over 10,000 American millionaires. 8 out of 10 invested in their company's 401k. 3 out of 4 also invested outside the 401k. 0 said single stock picking made them rich. The average time to reach $1 million, 28 years. 79% received 0 inheritance. 33% never had a single six-figure year in their entire lives. The top 5 professions of American millionaires: engineer, accountant, teacher, manager, attorney. There are more millionaire teachers in America than millionaire lawyers. Let that sit for a second. About 1/3 of the typical millionaire's net worth sits in their primary residence, which means roughly 2/3 is somewhere else, mostly stocks, mostly retirement accounts, mostly 30 years of automatic contributions to a fund they never touched. Real estate is the middle class's wealth builder. Stocks are the wealthy person's wealth builder. And the difference between those two groups is almost never intelligence. It is how many decades they kept compounding without flinching. Let me show you what this actually looks like in real life. 2 friends, both 32 years old today, same income, same $85,000 saved. Friend 1 drops it all into an S&P 500 index fund and keeps renting. Friend 2 puts it down on a $425,000 house. Both keep contributing to their 401k. 30 years later, they are both 62. Friend 1's $85,000 grew to approximately $1.5 million in the index fund alone, with his 401k. His total net worth is around $2.2 million. He rents near the beach now, pays cash for his car, travels 4 months a year because he has 0 maintenance and no property to manage. Friend 2's house is worth about $1.15 million. Mortgage paid off 5 years ago. He started maxing his 401k once the house ate less of his monthly income. But for the first 15 years, almost everything went to the mortgage. His total net worth, around $1.65 million. Same neighborhood, knows every neighbor, garage full of tools. Grandkids visit on weekends. Friend 1 is technically richer. Friend 2 slept better at 3 a.m. most of those nights, except when the dishwasher leaked. Neither one made a wrong choice. They made different choices, and they both stuck with them. But there's a third friend that nobody ever talks about. He started investing at 32, panic sold in 2008, bought a house at the peak in 2022, sold it at a loss 2 years later, jumped back into stocks during the rally, sold during the next correction, tried rental real estate during the years it did not cash flow. He has $185,000 at age 62. That is the friend most people actually become. Not because he picked the wrong assets, because he never stayed in anything long enough for it to work. Here's the honest framework. Real estate wins if you can put down a real down payment and hold for 15 years or more. Rent in your area is reasonably close to a mortgage payment. You have a stable job and are not planning to move every 3 years. And, critically, if you would otherwise blow that $85,000 on car payments and lifestyle creep instead of actually investing it. Stocks win if you have not yet maxed your 401k match. You live in an expensive metro where the price-to-rent ratio is 25 or higher. San Francisco, San Jose, LA, Seattle, Denver. You might move for work in the next 5 years. You genuinely do not want to spend your Saturdays fixing things. You have the discipline to keep buying through a 50% crash without touching it. For most normal people earning $70,000 to $100,000 a year, the right answer is both. Buy a modest primary residence, ideally at 1.5 times your annual income or less, which is exactly what the average self-made millionaire actually does. Then max your 401k to the match, fill up a Roth IRA, dump everything else into a low-cost index fund. That is it. That is the entire formula. Boring, repetitive, slow, effective. So which one will actually make you richer? Stocks will compound your money faster. Mathematically, real estate will compound your discipline harder, behaviorally. The first one rewards your brain. The second one protects you from it. Pick the one that matches who you actually are, not who you wish you were. If you will panic, sell your stocks in a crash. Real estate will probably make you richer, because the asset is glued in place. If you will never bother fixing a leaky roof, stocks will probably make you richer, because there is nothing to fix. Both work. Neither works alone for most people. Your realtor wants you to believe their thing is the only thing. Your stockbroker wants you to believe their thing is the only thing. But your interest is different. Your interest is to keep growing your net worth quietly, automatically, for the next 30 years, in whatever vehicle you will actually stick with. Stop arguing about real estate versus stocks. That is genuinely one of the dumbest arguments on the internet. Start arguing with yourself about whether you will actually keep buying either one for the next 30 years. That is the only question that matters. The richest version of you is not the one who picked the right asset. It is the one who stayed in the game long enough to find out it never mattered which one they picked. Here is the truth that nobody in this industry wants you to hear. The 5 times difference between stocks and real estate means almost nothing. The 38 times difference between homeowners and renters means everything. And the only thing separating those two numbers is whether you stayed. That factor, that one single factor, is not about the asset. It never was. It was always about you. If this video gave you something real, hit the like button so the algorithm keeps showing it to people who need to hear it before they make an $85,000 mistake. Subscribe if you want more videos where I just run the actual math instead of selling you a course. I am not a financial advisor. This is for educational purposes only. Your results depend entirely on your own decisions and your own actions. I will see you in the next one.